We started this in January of 2009 in response to the housing bubble and what happened at the end of 2008. And we kept thinking, all right, we'll get out in front of this, we'll get in front of people, and we'll hopefully get back to some sense of normalcy. Well, we haven't had a sense of normalcy since that time. In 2009 and 2010, we were dealing with the aftermath of the housing bubble. In 2011, we were dealing with the debt ceiling crisis. In 2012, we were dealing with the fiscal cliff. I'm not certain what Tom's going to tell us to expect for 2013, but I can just guess that we're probably not going to be anywhere near back to normal. That said, I'd like to introduce Tom Wirth. He's our Chief Investment Officer, and he is going to tell us about what he predicted last year and then what we can predict for this coming year. So, Tom?
Well, thank you, Melinda. Is this volume good? Good. It occurs to me that maybe normal is dealing with crises. And one of the items that Melinda didn't mention in 2011 that we dealt with, and the reason why I had to come here last year and sort of do a mea culpa, was we had the Japanese tsunami, which had a tremendous disruptive force on economic growth worldwide. So it has been a sense that we've jumped from one crisis to the next, some of them man-made, like what's happening in Washington, and others that are more natural, such as what did happen in Japan. But last year, as I said, I came here and we reviewed, as we review each year, the results of what we had predicted from the prior year. And we weren't really too much on the spot last year. This year's a different story. I think if we look from last year's slide and what we thought would happen last January, here were our conclusions. The economy would grow close to 3% for the entire year. 10-year Treasury note would remain under 3% for all of 2012. Housing prices rise for the first time in 6 years. The unemployment rate would drop below 8%, and the S&P 500 would return greater than 15%. This is a very positive message we had last year. And I remember there were several questions out here that were challenging me, and how could I possibly be so positive? And yet, as the year progressed, things worked out fairly well. One of the things I'll just mention as we start, this is the first year we've done dual screens, and hopefully this will help everybody focus. The only problem with dual screens is I only have one laser pointer. So I'm going to do it over here, but I won't use it on every slide, okay? So you might have to go back and forth here. But taking this one by one and looking at the results from last year. First one, the economy would grow close to 3% for the entire year. Here we have a slide that shows quarter by quarter, over the last 6 quarters or so, what has happened to GDP growth. And don't worry if you can't see these numbers. I'll talk through it. I know that they're a little bit small to be able to see. But we started last year, at the end of the year, with GDP growth on an annualized basis for the quarter was around 4%. And we quickly dropped down to about 2%, and in the second quarter last year was just over 1%. And then we jumped up to, again, 3% in the third quarter. We don't yet know what happened in the fourth quarter. The expectation is it's going to have dropped down and be closer to the 2% area for the fourth quarter. But what we have seen is a sort of a reacceleration in the economy as we move beyond the summer and into the fall. If we take a look at this from a long-term perspective on year-over-year growth, again, this is a little bit faint, but this goes back, this chart goes back 50 years, or actually 60 years. And what I want to point out is this is the line of demarcation between recessions falling below and then economic growth above. When we've had these deep recessions before, we've had powerful rallies coming out of those recessions, where GDP for a couple quarters will grow at an annualized 8 or 10%. And this happened throughout the whole course of these business cycles until we got to here, when we had the deepest of all these recessions, again, going back to I guess, post the Korean War, or as my mother's here, she's always correcting me on this, the Korean conflict. So anyway, right, Mother? I just want to make sure. Okay, yes, okay, thank you. But what I want to point out is, coming out of this recession, we did not have this spike that we saw in prior deep recessions. And the reason for that is this recession was caused by a bubble bursting. And when bubbles burst, there's a long process that we have to go through before we can get economic growth that is anywhere close to what we would consider normal coming out of recessions. The good news is the recession ended in 2009 here, in June of 2009. Here we are in January of 2013, and what I'm hearing less and less comments about is the prospect of a double-dip recession. And I think the reason for that is we're now 4 years post the recession ending. Maybe we no longer would call it a double-dip recession, but actually a new recession would occur, the next recession, coming through a normal business cycle. And that's good news, to get back to more normal cycles. So the trailing 12 months here is 2.6%. So we said 3%, we got 2.6 for real growth. One of the reasons why GDP continues to grow is because of car sales. Auto sales are still very important to our economy, the manufacturing sector of our economy. It creates a tremendous number of jobs. We started here coming out of the recession, or right at the end of the recession, with about 10 million auto sales per year in our country, cars and trucks. We are now at a little over 15 million annualized. So we have grown 50% in auto manufacturing over the past 4 years. Now, the good news here is all of this that has been going on throughout this whole cycle is lower than what we would consider normal. Normal is somewhere between 16.5, 17 million cars. When I say normal, what we had the prior decade on average. So when you have that, you have a tremendous amount of pent-up demand when you're under what would be considered normal. So being here now at 15 million, we would expect that this is going to continue to go not just to the average, to the 16.5, but beyond that as we start making up some of that lost production that we saw through here. And again, when we think about the auto fleet that's out there in America, we have the oldest fleet out there of all time, the most number of miles and the oldest. So that's all, again, looks positive as we look forward. 10-year Treasury staying under 3%. This seemed like maybe this wasn't so far out there. But what I want to tell you is that, yes, it stayed under 3% for the entire year. It's the first time since before World War II that the 10-year Treasury note remained under 3% for the first year. We started here at 2% for the year. We got up to 2.4%, and we ended the year at 1.75. But what I really want to point out is going back to 2009. In 2009, the 10-year Treasury traded at 4%. In 2010, the 10-year Treasury traded at 4%. In 2011, the 10-year Treasury traded at 3.75%. But then, as we said, 2012, 2.4%. We're calling this, and many people are calling it, the biggest bubble that is out there, being government debt and how low those yields are. We tend to agree with that. What is interesting is we saw a lot of volatility through these years, and then we've seen very little volatility here. So we'll see how long this lasts, but our expectation is that this will end. This low volatility of interest rates will end. Housing prices rise for the first time in 6 years. Here we show, starting back in 2007. Zero is right here. So we were dropping about 10% a year in 2007. Housing prices, this is national. Almost dropping 20% in 2008. We started to come back up here in 2009. It only dropped about 5% here, or 2.5 to 5%. Again, in 2011, dropping between 2.5 and 5%. But here we have 2012. We started the year in 2012 with year-over-year growth of minus 4%. And we're ending the year with housing prices increasing over 4%. So we have finally come out of that housing slump. It's finally occurred, and home prices are starting to rise for various reasons, which we'll get into. Unemployment rate drops below 8%. Here's where we started back in 2010. We were at just under 10%, and here we are today at about 7.8%. So we got under 8%. Some of that has to do with the participation rate of employment here in our nation, where we're lower than we've ever been as far as the number of adults over 16 years old working. But it also has to do with over 2.5 million jobs having been created over the last 12 months. So certainly we're going in the right direction. And finally, S&P 500 returning greater than 15%. This shows the growth of the S&P 500 from the end of the year. From the beginning of the year to the end of the year. The number here is 15.2%. Actually, this does not include all of the dividends that paid in December, and the actual number, when finally calculated, was actually 16%. So we just came in on over 15% for the year. So again, we were pretty much spot on there. So what were our highlights last year? The U.S. economy continued to improve. And it has been continual improvement. We saw those auto sales. We'll take a look at some housing charts. But everything was just sort of building on its own weight. So that's been the good news. It's continued improvement. Again, housing finally began to rebound. We saw home prices, and then we'll see actual housing starts, and that's finally coming to fruition, that the housing bubble is working its way through the system. U.S. elections became a non-event as the status quo prevailed. Well, what do I mean? Well, the Senate was controlled by the Democrats before, continues to be controlled by Democrats. House by the Republicans, continues to be Republicans, and of course, President Obama was reelected. So despite all of that money that was spent, we have the same political system that we had before the election. Fiscal cliff is resolved, and then I have in parentheses temporarily. And the reason for that is really it's three-legged here, or three-pronged. We started with a fiscal cliff. At the end of the year, we knew that if nothing was passed, tax rates were going to go up significantly for everybody, and there is going to be significant spending cuts that would hit the economy. So there was some agreement that came about that, and the market perceived that as very positive. We know what the market has done thus far in January. We're up about 4 to 5% this year. So that's good. The second leg was the debt ceiling, and we just had today the House passing legislation to push that out at least 3 months, so we don't have to deal with that immediately. And then the third one is the budget, to get a budget passed. So now we're put the debt ceiling with the budget. That's all going to be tied together, and it'll give the Congress a chance to really work on a solution. And what we really hope will happen is that we will have another sort of grand compromise that we had with the fiscal cliff back in December. It's got to be an aspect of getting together and coming up with a solution that's going to be long-term lasting, not just something that is a short-term fix. Not, we use the term kicking the can down the road. We can't continually kick the can down the road. There has to be some sort of a compromise that'll get us beyond that, which will help free up the private sector to be able to move forward. European crisis eased throughout the year. We'll see a couple charts there, but we haven't heard that. We haven't seen that in the news much over the last several months, and there's a reason for that. So let's take a look at our current situation, debt and deficit. First of all, we have a chart that sort of goes exponential. This is the amount of federal debt that we have outstanding. So we start here in the 1940s, where we had very little debt, and then it starts to grow in the 1980s, and then has really just gone straight up since 2008. But we don't just look at the federal debt as total outstanding. We have to look at it in relation to something, and what we look at it is in relation to our GDP. So here we have a chart that shows what it is in relation to GDP. If we go back to the end of World War II, the federal debt was 120% of our gross domestic product. Today, And when I say today, this is a chart from the Fed, and they've only updated this chart through year-end 2011. In 2011, we were at 96% of GDP. We are over 100% today. We're just over 100, maybe 101, 102 in that area. So if this was updated one more year, that's where we would see. But we're still way below, or well below anyway, what the peak was in 1945. Annual deficit as a percent of GDP. First of all, we look at this and what the World War II did to us. We saw that we were running 25% annual deficits back during World War II. We recovered to where we had surpluses almost immediately after World War II. And then for the most part of the 1950s on forward, we were between 2% and at the worst 5% deficit to GDP. We had the surplus coming out in sort of the peace dividend that was laid, and then in the Clinton administration having some surplus, and then we see us falling down to 10% debt to GDP, annual deficit to GDP. The good news is, and this is a shorter-term chart, looking at what's happened over the last 3 years. So again, the bit from the surplus here, or just a small deficit, excuse me, here. This was during Bush's end of Bush's second term, so 2006, 2007. We're running just over 1% deficit to GDP, all the way down to 10% deficit, and now we're back just a shade better than 7%. So without really much happening in Washington over the last several years, we've improved from 10% to just better than 7%. Why has it improved? Well, the economy's been improving. And so part of what we have here with the deficit is cyclical in nature, meaning the business cycle is very much responsible for a big portion of this drop. Now, I don't want anybody to think that I'm standing here saying we don't really have an issue here. Of course there's an issue. There's long-term structural issues on top of the cyclical issues, which is what our Congress really has to deal with. But the good news is, without the Congress really having to do much, we've already improved from minus 10 to just under 7%. Fiscal cliff and sequestration. So we talked a little bit about fiscal cliff. The sequestration was the policies that were put in place if we can't come to any terms with dealing with the deficit here and the debt ceiling, then there would be automatic spending cuts that would hit, mainly to, or it's about 50-50, to defense and then to some of the social programs. So we see here the amount of spending as a percent of GDP. So what we're seeing here is throughout, this goes back again 60 years, so throughout the good portion of, say, the 70s, 80s, 90s, we were spending about 20 to 22% of GDP. All right? We spiked up to almost 26%, and we're back to 24%. So when we had the big bull market in stocks and we're getting a lot of capital gain income, we actually went back below 20% here, and that's why we had the surplus as our spending had dropped significantly. Again, unemployment rate was under 4% at this point. On the other side of the coin is revenues. How much revenues are we bringing in? And if we look at these revenues, throughout most of this period of time, we're between 18 and 19% of GDP we're bringing in to the government. So we're running 18, 19% revenues, 21% expenses, so a deficit on average 2 to 3%. All right, a manageable deficit. So here we are today. We bottomed at 16%. We're at 17% over the last year. So again, we're still almost 2% below what might be considered optimal. Defense spending, however, again, going back to the end of the Korean conflict, was at, when we look at this, was around 15% of GDP. And then it's had a long decline as a relationship to GDP, all the way down to below 4% before 9/11 hit. So after 9/11, of course, we had to ramp up our military, ramp up Homeland Security, and so forth. and today it's running a little over 5%. So a significant increase, 4% to 5%, of course, is a 25% increase in spending. As a percent of GDP, it's only 1%, but it's still a significant increase that we have had in relation to GDP. But I believe this trend is still pretty much intact. As you see, this peak is far below the peak that we had back in the early 1980s when we were, when Ronald Reagan was doing what he was doing to defeat or to win the Cold War, I guess. So after the peace dividend we had got us all the way down to that under 4%, and now we've increased it. What I state here is reinstating the full Social Security insurance premium will be beneficial in funding our social insurance. So what does that mean? Well, here we see over the last 10 years Social Security revenue increasing at a fairly steady rate of about $40 billion a year. What is the Social Security revenue? Well, that's their payroll tax that employees and employers pay into the system. And then in 2008, it stopped. Of course, we had the recession, and we actually declined a little bit. And then we had a little bit of a recovery as people started to get their jobs back. And then we had the big decline over the last 2 years. Why the big decline? Well, we had the 2% holiday for paying in payroll taxes. One has to question, was that smart policy? I would come about and say, no, it's not. We should be fully funding as much as we can our social insurance, our Social Security insurance. So that's a social net that needs to be there, and reinstating that 2% as part of our compromise in dealing with the fiscal cliff was probably the best thing that we could do for our budget. A lesson from 1945, and I think this is very valuable, and I know this is very busy, but I'll talk you through it. There are 18 recessions going all the way back to 1914. So these are all the shaded areas. In only one of these recessions, and this was the one in 1945, did it occur without the Fed raising interest rates. The other 17, the Fed 16 of them, the Fed raised interest rates dramatically before the recession hit. The 17th was actually in 1937 when they didn't raise interest rates, but what they did is they doubled the reserve requirement that banks needed to have. And what this effectively done is halted banks from lending any money out. Well, if banks aren't lending any money, the economy is going to sink, and that's exactly what happened. So in 1945, however, we had what we would call the only recession that occurred due to fiscal tightening. So what is fiscal tightening? Well, there's monetary tightening, raising interest rates, or fiscal tightening, reducing expenses. So what happened when we reduced expenses? Well, we saw how back then we were running 25% deficits, and then we had a surplus shortly thereafter, and that wholly occurred because of the demobilization from World War II. We see here we are spending over 40%, almost 50% of our GDP. We're spending about 50% of our GDP. We went all the way down to 15% in just 2 years' time. So tremendous tightening that was occurring, tremendous reduction of what our government was spending. It would be equivalent, as I state here, to having a $4.7 trillion spending cut in 1 year. Now, we're talking about $4.7 trillion over 10 years right now. So just 10% of what happened in 1945. So what happened to GDP here? Well, we see nominal GDP went from about 10% growth in 1944 to a very shallow decline in 1945. It caused a recession. But by 1946, we got right back up to 10% growth. So it's a very short-lived recession. What happened to the Dow Jones? I think this chart is interesting for a couple reasons. Number one is looking at what happened during the recession. The Dow Jones rose 20% from start to finish. But number two is to take a look at these numbers. The Dow Jones was 140 back in 1944, and by 1946, it was over 200. Well, add a couple zeros. Where are we today? We're at 14,000. So does this mean in 2 years we could potentially get to 20,000? That's probably a little short, but I do believe in the next few years, the Dow Jones or the stock market could really have a boom time. But it has to have a boom time if our Congress can come to some grand compromise, something that is just going to get them out of the way to allow business to once again invest in their future. What was happening to the private sector in 1945? Again, the government getting out of the way allowed the private sector to expand rapidly. And we saw during the recession, the private sector was growing very, very quickly. So the government was slashing, but the private sector was investing. All right, so what's going on in Europe? I think all you need to know about Europe is what's happened to interest rates. And I'm sorry for the darkness of this graph, but I do believe it tells the story as we look at these peaks. This is the 10-year yield for Italian debt. So we go back here to 2010, and 10-year debt for Italy was around 4%. And then we had the European debt crisis in 2011. It got us up to over 6%, a little bit of a relief. And then a big spike here in the summer, and this is sort of when we were going through our own fiscal crisis, where we got over 7%, and that's where the warning really hit. We got north of 7%. Again, a big decline, a little bit in the summertime of a spike here to over 6% again, but today we're back to this 4% level that we were here 3 years ago. So we've gone through this full cycle of having a crisis in Italian debt. Spanish debt is not quite come back as far as the Italian debt has, but nevertheless, having spiked here well above 7% just in, again, last summer, here we are now at 5%. So in both countries, we're starting to see a little bit of relief. There's a reason for that, and that reason is the ECB, the European Central Bank. There is a new chair of that, like Bernanke is here, a person named Mario Draghi. And he has really taken the same steps that Ben Bernanke took here 3 years ago in adding liquidity to the system. By adding liquidity to the system, you sort of relieve that pressure valve that was building so much pressure has been relieved. And now, and I think Draghi is really committed to following this, and we would expect that these interest rates are going to remain sort of calm down than what we've seen over the last couple of years. So this is good news. It's going to allow Europe to heal some. We know Europe is well behind us as far as economic growth, but there is thought that Europe as a region will come out of their recession during this year. So what's happened to the European stocks? Well, after falling dramatically over the last couple of years, we bottomed here in the summertime. And since summertime, large cap European stocks are up 40% from their trough. So there's been significant recovery. So not only have interest rates calmed down and been lowered here, but the stock market is taking note and has appreciated remarkably over the last 6 months. Manufacturing. So if we look here at manufacturing, we had the recession, and then we had a nice spike, and now we're right back to the flat line, meaning there's really no growth going on in the manufacturing sector. I would propose that the reason why there hasn't been any growth is because businesses do not want to invest into the future without knowing what tax rates are going to be. All the things that are sort of holding us up in Washington affects small businesses particularly. And so businesses are sort of, they're going along, they're not adding to employees, they're not adding to capacity, they're just sort of managing their businesses, and we're sort of flatlined here. And we're seeing that also with new orders. So new orders are sort of flatlined here. They're not really growing like we'd want to see. Hopefully, we're coming to the end of that. And I think as we move through this year and we move through these through the budget compromise that we're going to have, as well as the debt ceiling, we're going to see this start to grow again. Beyond that, one of the reasons to have some optimism is the emerging markets are once again reaccelerating, particularly in China. The last quarter in China was the first quarter in 7 that we saw the rate of growth accelerate. So we've been decelerating, and then it just rebounded in the last 3 months here. So again, positive news as we look forward to the manufacturing sector. Capacity utilization. We're back to where we were at our peak here before the recession, certainly well below where we have historically been. But I would state that much of the capacity that's out there is obsolete today, and that in order for us to get to further capacity utilization, we're going to have to put on more manufacturing capacity so that we get more modern facilities out there. So again, the reason why we can't get beyond this level is because businesses right now are willing to really expand to the level they want to expand given what they're seeing in the future. Housing. Here's the bright spot, the biggest bright spot. This line right here is a line of 1.5 million homes being built per year. It's the average that we've had going back 60 years. So 60 years of data of new homes being built, on average, per year, 1.5 million units. We see here in recessions that we've had, spikes down to, and I know you can't read this, but this is right around 1 million units. And then we see coming out of recession spikes that would take us up to 2 million or north of 2 million. So this is pretty typical boom-bust cycles in housing every time it came, except for when we got to this recession right here, when it didn't come down, which would have been typical. So this was the recession in 2001, 2002. So when that happened and we kept going higher is when the bubble occurred. We didn't release that bubble back in this recession, so we went 20 years of just solid growth happening in new builds until the bubble finally did burst. And when it burst, we didn't have this sort of V bottom that we've had in the past. We had what we call an L bottom. But look what's happened here over the last 6 months. We've gone from about 600,000 homes being built per year to almost to 970,000, basically that happened on an annualized basis last month. So we still have a long way to go to 1.5 million, but we are off the bottom, and the trend is certainly very positive. Vacancy rates have fallen sharply. So we saw vacancy rates, home vacancy rates, here up to almost 3%. We're now down to under 2%. Again, this is giving us data to tell us that there's a need now for new homes to be built. Even better, the median household income can afford almost double the median priced home. So what does that mean? Well, what the Fed does is it takes a look at what the average house being sold for is each month, and what it costs to finance that in a 30-year mortgage at these low rates. And what they're finding is that the median income, the median household income, can actually afford twice as much as what that payment would be on the average priced home that's out there. So that means that there is tremendous ability for households to afford homes today, much more than ever in this, I'd say, history. This goes back to 1980 back here, but it is a very positive message. And it's one of the reasons why the Fed has continued to keep rates as low as they have, because they want to spur the demand for homes. Inventories are back now below 5 months' supply. So we were all the way up here to almost a year's worth of supply, and now, again, back to what would be considered a very low amount of homes out there in the marketplace. Home builders are becoming much more confident, and you can see why after looking at the housing starts really starting to accelerate. I would expect that home builders are going to be we're not quite up to 50. 50 would mean it's a level where you have more builders that are confident that they're more confident in the future than what they have been. So at 50, once we get there, it's just as many positive as negative. The one issue that remains out there are delinquency rates. They are still very, very elevated. And the reason for that is we know there's many, many homeowners that are still underwater in their mortgages and have just made the determination they're not going to pay. They're not going to pay their mortgages. So that being said, we had to continue to work through the foreclosures that have been plaguing, clogging up the system. But beyond that, everything else in housing is very positive. Consumers. Once again, because the Fed has kept interest rates so low, consumers now can afford a lot more. What this shows is the percent of your income that goes to paying debt. So at the peak here, right before the recession, we were around 15%. So 15% of national income was going to pay principal and interest on loans. This down here, we're now at 10%. So we fully cut by a third the amount that we're paying in interest and principal to our loans. This is about at the same level that we have seen in past cycles. So this goes back to the early 1980s and then again in the 90s. So this, I just say this is a very positive sign when you have consumers that have cut their debt load because they're able then to go back out and reestablish credit. And that's exactly what we're seeing. Consumer credit, after taking like 3 years of not growing at all, has started to accelerate again. And in fact, if we look at this is around 5% acceleration, meaning we're growing at twice the rate of inflation. Consumer credit is. So that's another good sign for our economy as we move forward. Consumer spending. So not only is credit expanding, but spending is also expanding. Again, at a rate of over 3% per year. This is real, by the way, consumption. And then savings have also stabilized. So before we had almost negative savings back here, we're stabilized here and now in about the 3 to 4% area. That is a national savings rate. So that it's not as high as what it once was at 7 or 8%, but it's much better than where we were. Now, we showed the auto sales coming from the bottom from this point forward. What I wanted to show you was the longer-term trend, and I said the prior decade, which is this area right here, we averaged between 16 and 17 million autos being sold a year. So we're still below that average, and we have all of this pent-up demand that's been building over the last several years. So we would expect that this line not only will get here, but will actually spike eventually up to the 18 million area. And I say eventually, in the next 3 to 4 years. Consumer confidence has stabilized here, but much lower than where we were. Now, this is sort of a good news, bad news. You want consumers to be confident because when you're confident, you're going to go out and buy. However, it's also at the peak of confidence when recessions begin. Because if you can't go any higher, it's that rate of change will actually drive you into the next recession. So the good news is that staying here at a stabilized rate but at a low level means that we should continue to have this economy expand because the trend should be to continue to go higher. Credit and velocity of money. We showed consumer credit. This is credit at all commercial banks is now growing at a rate above 5%. Now, we're falling at a rate of 5% coming out of the recession. Why was it? Banks had to recapitalize. The capital standards were much more stringent. You had to have more capital. So banks had to take the earnings that they were producing and redeploy it into their capital rather than giving it out in loans. Now, capital standards have been reestablished. Banks have gotten their capital back to levels that they can continue now to grow their loans. So loans growing 5%. Again, bank credit is the lifeblood of our economy. And without having that credit going through the system, we can't have economic growth. So having now 5% tells me that we can continue to grow the economy. This shows the velocity of money. Now, when we look here, and again, this goes back to the 1960s, the velocity of money averaged over this period of time right around 2.2 times. Now, what is that? I should take a step back. What is velocity of money? We should think of this as in manufacturing as inventory turns. How fast do you move your inventory? The faster you can move the inventory, the more turns you can have on an annual basis, the more profit a company can have. It's the same way with money in our system. The quicker we can have that money turn over, the more growth we can have in our economy or profit in our economy. So when we have the velocity of money down here below 1.5, which is sort of stagnated here, it's telling us that we haven't yet unplugged the economy. Now, the reason why we don't have inflation, given how much money the Fed is printing, is solely based on this velocity of money. And as long as the velocity of money stays at this very low level, it doesn't matter how much money the Fed prints, we can't have inflation. We just won't, because the money just sticks where it is. And the velocity of money, as the Fed's been printing money, has been declining. And that would occur. If the Fed were to print a lot of money and just have it sitting in the banks, it's just going to make this velocity of money go down lower. So until we can fully unclog what's happening in our financial system, we're not going to have inflation out there. That's why the Fed is very comfortable keeping rates very low for an extended time, because inflation is not coming through the pipeline. Finally, the stock market. This is the S&P 500, and this goes back to, I'm having a hard time seeing myself, to the early 1990s. So you start here in 1993, so it's a 20-year chart. And back here in 2000, the S&P 500 hit about 1550. We had the stock crash in 2000, and we got down here below 1,000, back up to the 1550, back down to 1,000 or below 1,000, and now we're back up to about 1,500 on the S&P. So we've gone through these long cycles. Since this period of time, nobody's really made any money in the stock market, but you've had a lot of sleepless nights during this time. What's happening, however, to earnings in the market? If we were to look at earnings going back here, earnings were about $50 a share per S&P share back in 2000 when we had the first crash. Earnings today are around $100. So earnings have doubled while the stock market has gone sideways. And thus, as we look at the PE ratio here, we started here at about 27 times earnings, back again at the peak of the market here, and today we're around 14 times earnings. So the PE ratio has pretty much been halved, which makes sense because because earnings have doubled while the stock market has remained sideways. The interesting thing is looking at this last rise in stock prices here since the recession ended, the PE ratio has remained very, very stable. So the market, although having been up about 50% from the bottom, or a little more than 50% now, is not any more expensive today than it was in 2009. So that again is good news as we think forward. And finally, as we look at stocks in relationship to bonds, which is what most of us have, one of two asset classes, or one of three is cash, but then there's fixed income or bonds, CDs, so forth, or stocks. And there's relation to them. And the relationship is demonstrated in this graph. The green line is a 10-year Treasury yield. And this chart goes back 40 years. And we have the 10-year Treasury yield back at the peak of everything, about 15%. And then we end here below 2%. Well, think about if you could get today a 10-year Treasury bond, and it's going to pay you 15%. How many people really want to invest in the stock market, knowing what we've gone through here? And there are not very many people, right? Give me the 15%. I'll take the 15%. So what happens is stock prices go down significantly because there isn't much demand. So we look at this blue line as a proxy for this called the earnings yield. So we know what a PE ratio is, price divided by earnings. So if you have a stock that has $1 of earnings and it trades at $10, it has a PE ratio of 10. Well, earnings yield, we just flip that. We take a look at the earnings and divide it by the price. So $1 divided by 10 would be a 10% earnings yield. Now, let's say that the stock price goes to $20. The PE ratio would be 20, right? Still the same dollar of earnings. But the earnings yield, $1 divided by 20, is now 5%. So the earnings yield declines as the price rises. So this is what we would expect to happen as the yields on the 10-year Treasury note dropped. The earnings yield was dropping because prices were going higher. There's more demand for stock because now as time went along, you could only get 7% in the 10-year Treasury, then 5% in the 10-year Treasury, and now we're down to 2%. But at some point here, this relationship broke. 10-year Treasury continued to fall, but the earnings yield started to rise again, meaning prices were falling. Okay? And now we have the biggest gap of all time between the 10-year Treasury, again at 1.75%, and the earnings yield today, which is about 7%. That's going to have to, in some way, correct itself. At some point, we're going to get back to having a very straight relationship, and it more than likely is going to happen in a combination of two ways. Yields are going to start rising on the 10-year, and prices are going to start rising on the equity market, driving down the earnings yield. And somewhere in the middle here, they're going to meet again. And I don't know, how far out this goes, 5 years, 10 years. At some point, it will happen. I've had this chart in here for a couple years, but I want to reiterate what our belief is. Our belief is that the focus is going to continually be on equity income, particularly with bond rates so low. So what does that mean? What equity? Well, dividend yield. Focus is going to be on dividend yield as investors, particularly baby boomers, people who are early years of retirement, they need to have their assets work for them. Well, they're not going to have them work for them in the bond market earning 2%. It's just no one's going to be able to retire if all they can do is get 2% on their money. So they have to look at stocks, but they don't want to have the volatility of the stock market. They want to be able to use the income it's generating. So dividend yields are becoming more and more important in investors' portfolios. So again, stocks need to return above and beyond capital appreciation through income yield. I show Walmart here, and I showed this chart last year, and I just updated it, but I think it's been a great year. This is Walmart going back 15 years, and the price over this period of time didn't do anything. I mean, it went up, it went down, but basically it traded in a very narrow range. What we've seen this last year is a breakout of Walmart stock price. So we were trading here around $45, right through here, $50. Today, it's about $65. Over this period of time, earnings grew, however, from at this level here, about $1.25 right here to $4.79 over the trailing 12 months. Over the last 4 quarters, the company has earned $4.79. So it has gone up almost fourfold in earnings, while the stock price did absolutely nothing. How about their dividends? What do their dividends do? Well, the dividends started back here at 28 cents a share. Today, it's $1.50 a share, $1.60 a share. And the PE ratio has fallen from a high back here of 40 times earnings to 13 times earnings today. So what we've seen here is even though the stock wasn't doing anything, stock price doing nothing, the company was continually, year after year after year, growing their earnings, and year after year, growing their dividends. And eventually, the price catches up to the fundamentals. The fundamentals of the company were solid, were strong, were improving, and the price was going sideways, and eventually we have a breakout to the top side. And this is what we're seeing in stock after stock after stock. Long periods of consolidations, and now in this last surge in the stock market, a breakout to the top side. Again, very positive metrics for the market. I showed this chart again back in 2010, and basically what I said is here are the yields on these 7 stocks. If the companies continue to grow their dividends at the same rate that they grew it the past 5 years, this is what the yield, if you had bought it that day in 2010, would be in 2015. So in 2010, if you bought Walmart at $50 a share, you're getting 2% dividend yield. By 2015, if they continue to grow their dividend, that yield at your cost will be 4.75%. So significant increases at these blue chip, and these are all blue chip companies, as we all know them. They were all returning to their shareholders above and beyond capital appreciation. So what has happened? Well, here's their dividend at January 1st, 2010. Here's their dividend January 1st, 2013. As you can see here, they've all grown their dividends significantly. The lowest one being Coca-Cola has grown at basically 25% over the last 3 years. This is not annualized. This is point to point. Microsoft has grown their dividend 76%. So we're 3 years in. By the time we get to 5 years, Microsoft, I'm certain, will have more than doubled their dividend. Walmart might not get to double their dividend, but they're going to be darn close to it by the time we get to 2015. So again, these companies understand what their shareholders are demanding, and the shareholders are more and more becoming retirees, either through the mutual funds that they're investing in or individual stocks. So that leads us to what we expect for the next 12 months. We think economic growth, having slowed down a little bit here in the fourth quarter, is going to reaccelerate as we move through 2013. Again, why do we believe that? Because we think Congress is actually going to come to some kind of a compromise. I know that's a big statement to make, knowing what our Congress has done. However, I think they got the message. I do believe they got the message. And we saw that with the fiscal cliff. They didn't allow us to go over the fiscal cliff, which was good. And they had some compromise with that. I think there's going to be further compromise as we get to this budget deal in May. 10-year Treasury note will end in 2013 above 3%. So right now we're at 1.75. We expect there's going to be a big move in interest rates. The reason for that goes back to our first point, economic growth above 3%. We believe that at some point during 2013, investors are going to recognize that the Fed will eventually have to start raising interest rates. So, that's weird. So we think that this is going to be the worst performing asset class of all asset classes, those long bonds. Housing starts end the year at an annual rate of 1.3 million units. Remember, in December, we had an annual rate of 970,000 units. So a further 30+% increase in housing starts between the end of 2012 to the end of 2013. But by the way, I should point out, it is estimated that for every home that is built, 3 jobs are created. So when we think that we're going to have, say, 400,000 homes, more homes being built next year than this year, that's 1.2 million jobs created. And it's not just those people who are actually building the homes. Of course, it's the appliance manufacturers, it's the carpet, everything that goes into a home. But it's been a pretty solid number that comes from the National Association of Home Builders, and it's been around for a long time. But that is going to certainly help to get that, to continually drive that unemployment rate lower. So we say over 3 million new jobs are created. Again, over a third of that coming really from the housing sector. The rest of it is going to be from the service sector primarily, but also from manufacturing. And the fact that government jobs, which have been on a long decline since 2008 overall, have been on decline, are going to stabilize here in 2013. And then finally, the S&P 500 again returns greater than 15%. Now, when we said this, it was January 2nd. Okay, so when we put out our investment outlook for the coming year, we already have 4%, so we're almost a third of the way there as we sit here at the end of January. Of course, there's going to be volatility in this number, but we do believe that the money flows that have been going into bond funds year after year ever since 2008 have begun to reverse, coming out of the fixed income funds, out of bond funds, and will start migrating to the equity funds, simply because, again, as people are looking at their bond returns and seeing negative numbers, they're going to want to put their money somewhere where it's earning, and that is in the equity market, in the stock market. As I do every year, I'll leave with a quote. This is from Arthur Schopenhauer, who was a German philosopher back in the middle of the 19th century. All truth passes through 3 stages. First, it is ridiculed. Second, it is violently opposed. Third, is accepted as being self-evident. So I'll let you all determine which part of my speech is the truth. And we'll see it next year when we come back and reconvene. All right, who has the first question? Dick.
Something like Sandy, Hurricane Sandy, when the recovery from that takes over, is that going to be big enough to affect the housing market and that sort of thing?
Well, I mean, certainly, all things being equal, Sandy destroyed many homes, and there's going to have to be homes being rebuilt. So on the margin, yes, that is going to help the housing market. One of the things we have to understand in economics is you don't actually create economic growth when a window breaks and you replace the window. You have the same window. So when you think about homes that are destroyed by something like Sandy and then being rebuilt, it is only to the extent that what you're building is an improvement on what you have, whether it's square footage, whether it's the appliances that you're putting into the new home, brand new appliances, things like that actually help spur economic growth. It's not the fact that you're replacing one home with another home. It's what have you done to make that better. So that will help GDP though throughout the year more than likely as homes are being reconstructed. We had to have some other questions. Okay, back here.
You mentioned that the consumer savings going up, and that's good. But the more they save, the less they spend. If the consumer spend, that's good for the economy. So what gives? For example, in Japan, the consumer savings is usually very high.
20%.
Yet the economy is not doing too good. So.
Yeah, the savings rate in Japan is extraordinarily high. A lot of that has to do with the demographics of Japan, a much older population than what we have here. Consumer spending represents approximately 70% of our economy. So it is very important. However, that being said, we have to have some savings rate to help our economy. And the reason for that is as consumers in aggregate, as we as a population in aggregate save, that money goes where? It goes into the banks and the financial institution, which then have that money to be able to lend back out into the economy, particularly with businesses, to help spur economic growth. So we had to have some steady rate of savings. 3% is still a very low savings rate. I mean, I think ideally they like to see 6% in an economy, but 3% is better than 0. So you can't continually have a 0% savings rate and have economic growth long term, because that's not adding any money into the bank system, into the financial system. We have to have some savings rate to allow growth to occur. So there's a happy median there. That would be ideal. So 3% is still lower than ideal, but it is spurring economic growth. Karen.
Thank you. Tom, could you talk a little bit about the global economy and what you see in emerging economies and how that's affecting the United States economy?
Certainly. So we all know that throughout the last decade, the emerging economies were really the catalyst for much of the global economic growth. What was going on in China in particular, but it wasn't just China. It was, we call it the BRIC countries, which was Brazil, Russia, India, and China. That growth globally ceased coming out of 2008. Now, when we say growth ceased in China, that means we're going from 12%, 13% GDP growth down to 6% GDP growth, which we would all love to have here, 6%. But for them, it was a recession. And that's what I'm saying. What I was saying in China, we have seen the trough, and the Chinese economy is beginning to expand at a greater rate. It's always that second derivative, the rate of change, that really matters. It's not, if you go from 7% GDP one year to 7% the next year, you're not really extending the economic growth. But if you go 7% to 8%, that is huge. And China, we expect by the end of 2013 to be back to double-digit growth. What that's going to do is going to help the commodity producers. So steel prices, which have absolutely collapsed over the last few years, we're starting to see that stabilize. Copper prices, which again had collapsed, are starting to stabilize again. We're going to see, and we are seeing it in oil prices. Oil prices have started to rise again. You don't want that to go too far, certainly. We saw when oil got to $130 a barrel here in the United States, that was at the peak in 2008 before the bubble burst. But you do want to see some price appreciation in those areas and demand pick up, and so that's what we're starting to see. And I would expect that the emerging economies are going to lead the rest of the world out. The United States has been very stable. It's been the stability of the rest of the world as we've gone from 2008 to today. But we need to see the rest of the world start to pick up, and that's where emerging markets are certainly going to have. They'll certainly be the catalyst to allow that to happen. Everybody must be thirsty. Yes.
This is a political question. I don't know if we want to deal with it, but I was wondering, how do you think that the Congress is going to deal with the pressures, on the one hand, to lower the national debt, on the other hand, to continue all the expenses that are now outstanding, including those for the so-called entitlements?
So the way I look at this is there's got to be short-term solutions and long-term solutions. Short-term, the solution is the cyclical upswing that we're on, and we're seeing the deficit, the annual deficit, go from minus 10% to about minus 7% and improving. So in the short term, some of the pressure that we've seen is going to be self-improvement. What we really worry about, however, is looking out 5 to 10 years when the bubble of the baby boomers, that sort of those that were born in the mid-50s, get to retirement age, and that is going to be devastating to our deficit unless we do something. So we need to address entitlements. There's no way around it. We can't keep going as we are today. So some grand compromise has to come up where we don't impact immediately what's going on, but long term there is some solution that is going to stabilize the entitlements that we have for retirees. So you don't want to take away, but you have to at some way revise what has been promised. Anyone else? Well, thank you all for coming.
Thanks, Tom. Your comments are always interesting, and we really appreciate your attendance and your loyalty, especially those who have been with us for the past 5 years. We hope to see you next year. Several of our staff members are here. We invite you to stay after, have cocktails, hors d'oeuvres, mingle with our staff, talk about whatever you feel you want to talk about. And I neglected to introduce our President and CEO, Ron Bentley. He's at the back, and he's here as well if you want to have a few words with him. So again, thank you for attending. Drive safely, and we'll see you next year.